Okay, we're going to get started. The Center for Business Law at Case Western Reserve University Law School is thrilled to have Professor Andrew Schwartz here today. He's going to be speaking about his new book called Investment Crowdfunding. I just wanted to tell you a little bit about Professor Schwartz. He's from the University of Colorado at Boulder, where he has been a full professor since 2017. He teaches and publishes on corporate securities and contract law, and is an internationally recognized expert on investment crowdfunding. He attended Columbia University Law School, where he served on the Columbia Law Review and was the James Kent Scholar for 3 years. Before entering academia, he clerked on the Ninth Circuit for Judge William Fletcher, and then for Judge Naomi Buchwald of the U.S. District Court for the Southern District of New York. Following his clerkships, he entered private practice and was at Wachtell, Lipton, Rosen & Katz in New York City. As you know, he's the author of Investment Crowdfunding, a book he's going to talk about today, and he has published more than 40 articles in top journals such as the UCLA Law Review, the Minnesota Law Review, and the Notre Dame Law Review, and then in top specialty journals in the corporate areas such as the Yale Journal on Regulation and the Harvard Business Law Review. So with that, I would say that I'm going to turn it over to Professor Andrew Schwartz because he will take it from here.
Thank you so much, Professor.
Hello. Hi. Thank you. Thank you very much for this kind introduction, Juliet, and thank you, Anat, and the rest of the university and the administration for inviting me. I'm very happy to be here. And the name of my book and the subject is Investment Crowdfunding. Maybe I should have come up with a better title, but at least you know what it's about. And so what is investment crowdfunding? Let's start there, and then I'll talk a little bit about what is the reason for it, why are we doing this. I'll give you some discussion of how it's going currently, what's the current state of affairs, and I'll also discuss a little bit of international comparisons. I'm going to try to keep my comments to about 20-25 minutes, and then I think I'll receive some questions from Professor Beck and then from the audience as well. So thank you. So let's begin at the beginning. What is investment crowdfunding? It's like Kickstarter in that it's an online way to raise money for businesses or projects, except instead of getting a t-shirt, you get a share of stock or some other security. And that's from the time that Kickstarter was founded in about 2008, and there's also Indiegogo similarly. From the time that they were founded, there were people saying, hey, wouldn't it be great if people could invest in this way as opposed to just, giving money, paying in advance for whatever item it is that they wanted. And sure, that was a great idea. The only problem was 100% completely illegal. You're not allowed to sell investments in the same way that you're allowed to sell other things, cars, bicycles, or goods or anything. There are special rules, and the most important special rule is before you offer investment opportunities, which we call securities, before you offer securities to the public, like on a website, you must first register those securities with the Securities and Exchange Commission, the SEC, in Washington, D.C. And to register means to file a very thick document with mandatory disclosure about the company, financial information, risk factors, and other things. And if you don't do that, well, that's an illegal, unregistered public offering, and anybody who bought a share can get their money back. But the law can be changed at any time. And so it was. In about the year 2012, Congress passed a statute called the Jobs Act, Jumpstart Our Business Startups, JOBS. Jumpstart Our Business Startups, Jobs Act, and huge bipartisan support, signed into law by President Obama in 2012. And the main thing that this new statute did was create a new exemption from the usual registration requirement that I just described. There have been other exemptions that have been around for a while, most importantly maybe for accredited investors. If you sell securities not to the public, but only to professional investors or people that have $1 million or more to invest, we don't call them rich, we call them accredited. And if you sell securities just to accredited investors, that is exempt from the registration requirement. Hence, we've seen for 50 years how do startups get funded through venture capital funds, which are professional investors who are allowed to buy into these unregistered securities. But in the Jobs Act in 2012, Congress created a new exemption to the registration rule for crowdfunding. For if you follow the steps that I'm going to describe to you in a moment, if you follow a certain set of rules, you may go on a website, kind of like Kickstarter, and offer shares of stock or other securities to the public. But it's limited. It's designed to be a limited exemption. So first of all, a company that wants to raise money in this way may only raise $5 million per year. If you want to raise more, go have an IPO and register your securities and go to the New York Stock Exchange. Each individual investor is also limited in how much they're allowed to invest. It's a formula based on your net worth or your income, but for most people it turns out to be roughly $5,000 per year in all crowdfunded offerings. And the idea here is that, okay, we want to let people invest in unregistered securities, but we don't want them to lose their shirts. By definition, these are not millionaires who are not accredited, and so the law limits how much they may invest. There are some other rules. You don't have to do the full registration with the SEC, but you do need to file a thin, simple set of mandatory disclosures. You can't sell your securities directly to people. You can't just like post on your website, I've got a cool company, come invest. You must list your securities on a platform, it's called, an independent third-party platform, a website that is itself licensed by the SEC to do this sort of business. The only other thing I wanted to mention is that by rule there is, and this comes from the tradition in Kickstarter, these offerings follow the so-called all or nothing model. Meaning, at the outset, the company has to announce how much money it needs to raise and how long it has to do it. So the company wants to raise $600,000 in the next 60 days, okay? If only 20,000 or 100,000 of pledges come in within that time frame, the thing's canceled, nobody buys any stock. And the idea here is that if you were one of those people that pledged to what turned out to be an unpopular offering that didn't reach its goal, its target, the crowd will kind of pull you back to safety. The wisdom of the crowd will figure out which companies should get funded and which won't. So with that overview and definition, let me give you a little bit of a report on the state of the market. So as I said, Congress passed a statute in 2012, part of the Jobs Act, but in that statute, there were directions to the SEC to promulgate regulations for certain aspects. The SEC was very busy and had other things to do, and it took them 4 years to draft those regulations, but eventually they did. So that's why my chart begins in 2016. And so what we're looking at here is the number of offerings, the number of companies that tried to raise money using this method that I just described. As you can see in the earliest years, very, very few, and this is nationwide. But more recently, it's about 1,500, about 1,500, and it's been pretty steady over the last couple of years. My data goes to 2021, the book was just published, but it takes a while to publish a book. So this goes to 2021. It's pretty flat since then. About 1,500 companies are raising money in this way each year. This next chart gives you, it's relatively similar, but it gives you an idea of how much money is being raised by these companies. And as you can see, in the earliest years, it was 20 million, 60 million maybe. But in the more recent years, and again, it's been pretty flat since the end of my chart here, roughly $500 million is invested each year into these roughly 1,500 companies over the last couple of years. Is that a lot of money? Is it not that much money? I can tell you this, it's about 1% of the amount of money that is invested through venture capital. So very, very small. But as you can see, it's growing. It used to, like 3 years ago, it was 0.5%. 5 years ago, it was 1/8%. So it's growing very, very fast. And a couple of other stats that I don't really have up here. There's been about a little more than 100 companies each year lately that raise more than $1 million. But most companies, on average, they raise about 400,000, 500,000 on average. Some raise less, some raise more. And so now that we've got a bit of an idea of what is crowdfunding, how is it going, let me answer the question of why. Why is crowdfunding? Why did Congress pass this law? What was the impetus? And really, there's three main policy goals. The second and the third are closely related. The first one is simply that startup companies, small businesses are good for the economy. They grow employment, they move the economy forward, they develop new products and services, and it's just good for the economy to get more funding. So here's another way for companies to get funded. The second rationale, the second and third policy goal of this law both relate to inclusivity, but inclusivity in two different directions. So first, remember, for decades, retail investors, people who did not have $1 million to invest, were legally barred from investing in these sorts of early stage startup companies because they don't have registered securities. It was thought that, sure, these are risky, but people should be allowed to spend their money as they wish, or at least some amount. If you can go buy a $85,000 pickup truck at will, or go to Las Vegas and gamble your money as you wish, surely you should be allowed to invest a couple of $1,000s in speculative startup companies. And so we wanted to give retail investors, we wanted to include them in the class of investors that are allowed to invest in startup companies. And as you can see here, the people have really taken this up. In the early years, quite small, it was pretty obscure, but more recently, roughly 500,000 investors have been investing each year for the last several. Some of these are repeat, but my sense is that there's probably at least 1 million or maybe close to 2 million at this point of individuals who have invested. And we only have 320 million in the country, so people are interested. And so it's grown a lot. The average check size, the average amount that people invest, is about $1,000 per offering. But I should mention, this hides a large standard deviation. There are a few investors that invest 10,000, 20,000, and then there's a lot that invest 200 and 400, and so it ends up with an average of about 1,000. But most of these people are investing about a couple of hundred per investment. The final piece of the policy behind investment crowdfunding, remember, number one, more money for startups. Number two, inclusive investing. Number three is inclusive entrepreneurship. Entrepreneurship, venture capital funds, have been really concentrated in certain specific geographic locations. Most famously, Silicon Valley, also New York, LA, a couple of places. My hometown of Boulder is a bit of a hotbed for this sort of thing. But there's a big country out there. There's a lot of places that are nowhere near Silicon Valley and nowhere near these other areas. And so geographic, rural entrepreneurs or entrepreneurs, and I mean, to be honest, one of the things that I'm trying to do in my book tour is not only to go to Los Angeles and New York, but to go to other places around the country. I think I might be heading to Ames, Iowa, in not too long. Because part of the idea here is that there are people all across the country with interesting and great business ideas. And because this is all conducted over the internet, geography is not really an issue. Also, another aspect of inclusive entrepreneurship is women founders and minority founders. For reasons that we don't have to go into now, venture capital funds have invested relatively little in female-founded companies and minority-started companies. But one of the goals of investment crowdfunding is to give these sorts of people who kind of haven't been given a chance. To people that are out of the loop, they live somewhere else, or they don't have connections to wealthy investors. This is a way to make a more inclusive market for entrepreneurs. And as you can see, female-founded companies under venture capital funding, less than 10% of the money went to them. This is a bit, I have to confess, that this is a slightly apples and oranges, because my 10% is, it's kind of the amount of money that went to female founders, whereas my 46% on the green for investment crowdfunding is the number of companies that were funded. So venture capitalists, in their defense, they do invest in a lot of women-started companies, but the bigger investments are maybe in heavier equipment and things like that. And minority founders as well. All minorities, putting them all together in venture capital, in the 20%, whereas with investment crowdfunding, it's in the 40s. And if we were to look specifically at black entrepreneurs, the statistics are somewhere in the range of about 1% of VC funding goes to black entrepreneurs. And in investment crowdfunding, it's 4%. Now look, I mean, you might say, I wish it were higher, okay. But 4 times as much is a huge leap. And in fact, on these platforms that run this business, you can, the entrepreneurs will often identify themselves as, African American, women, or, things like that. And you can search in that way, and people do. And there's a lot of the people that are investing in these sorts of opportunities are specifically looking to invest in these sorts of companies. So, now that we understand what is investment crowdfunding and why are we doing it, let me give you a bit of an international report. Because as mentioned, I studied this area of law in New Zealand as a Fulbright Scholar, and I've been to Australia and Korea and Canada and all over the world, the UK, to talk to regulators, to talk to entrepreneurs and people that run platforms to get an idea of which systems are working best. Because each country kind of adopted slightly different versions of this investment crowdfunding statute since we passed the Jobs Act in 2012. And what I found is it's possibly a little bit hard to see, and I apologize. What I'm showing here is international crowdfunding, comparing the US in blue, the UK in red, New Zealand in green, and Australia in purple. I guess Australia probably should have been green, I'm sorry. And then I normalized all of the amounts raised each year on a per capita basis. It's obviously unfair to compare how much money was raised in New Zealand, that has 5 million people, to the US with 325 million. So I normalized it using US dollars and on a per capita basis. And as you can see, so the US is pretty small but growing, the blue line. The UK is enormous. And in fact, the UK these days, there's more money raised and more deals on investment crowdfunding platforms than by angel investors in the UK today. The UK started their market way back in about 2010, way back. And so they have the most mature market probably in the whole world. And New Zealand started in about 2014, also a bit of a head start. But as you can see, there's really different outcomes in different countries. And so I looked carefully, and this is I think going to be my final slide, although not my final point. My final slide is comparing some of the key legal or regulatory differences between these jurisdictions. And so I've got the US, Australia, Canada, and the EU, and then New Zealand and the UK. And some of the highlights I want to point out to you are, yes, licensed platforms required everywhere, but the second line down, mandatory disclosure. As I said, the US model for investment crowdfunding is to require mandatory disclosure, but just a little bit, but some. The UK and New Zealand went to the most liberal extreme, the most deregulated, free system that maybe you could have, and there's no mandatory disclosure whatsoever in these countries. Now, let me just pause for a second. You might say, oh my gosh, how does anybody know which companies to invest in if they're not told anything? Well, there's no mandatory disclosure, but there's plenty of voluntary disclosure. And think about it. If I were to stand up here and try to sell you shares in my company, and you ask me about what does your company do, and I say, I'm not going to tell you. No comment. Well, you're probably unlikely to invest, or you might invest at some ridiculous discount. So there's clearly a economic private incentive for entrepreneurs seeking to raise money to give voluntary disclosure, and that's what New Zealand and the UK are counting on, and it's actually worked quite well. From my experience, the disclosure in the UK, the information that they put forth about the company, financial information, otherwise, ends up looking very, very similar to what we have here. The difference is that some of the extraneous, costly, not really quite worth it aspects of our mandatory disclosure, they just got rid of those and made the whole system much more efficient and less expensive to raise money in this way. The issuer limit doesn't vary too much. I've been giving Canada a hard time. I'm telling them to raise their limit. I think that's too low, and those are Canadian dollars. But the investor cap also, the US doesn't have a great system. I prefer the Australia or Canadian. It's just simpler. In the US, you have to tell the platform your annual income and net worth, and then they calculate 5%. People don't want to tell the platform that sort of thing. I think that alone is a disincentive. And so finally, my final point, or really the thesis of the book, is this: that you could, and these left four jurisdictions, the US over to the EU, they follow the standard model of securities regulation, mandatory disclosure, and most importantly. But New Zealand and the UK, I refer to them in the book as the liberal jurisdictions because they're very deregulated and liberal. And of course, regulation has value, and of course, laws have value, but they also have costs. To file your mandatory disclosure document costs money. To hire a lawyer to figure out the relatively complex regulations costs money. And because these, by rule, you're only allowed to raise a couple of $1 million. It needs to be incredibly efficient and low cost, or it just won't be used. And it actually has been tried. Canada enacted a really heavy regulatory system 5 years ago. 0.0 people ever tried to raise money using that. So Canada changed it to this more reasonable system, and that's to their credit. But so in the book, I talk a lot about a variety of what I call private ordering methods, like those economic incentives of that I'm going to give you voluntary disclosure. And I'm not going to go into all of them here, but I'll mention one more. And my point is that the reason why the US and these other standard jurisdictions followed the standard model is they were worried that investors would get defrauded and cheated and invest in terrible companies. Well, New Zealand and the UK have put this to the test. And what they found is that the private incentives, the economic incentives, are really quite powerful, to the point that a very, very liberal regulatory scheme is satisfactory and keeps everything reasonably clean. It's somewhat anecdotal, but in the US, there's been one accusation of fraud out of the thousands of companies that have attempted to raise money. In New Zealand, there's been one accusation of fraud. In the UK, there's been one accusation. So it's not like the absence of these regulations have led to a snake pit of con artists. And one of the key aspects of private ordering, one of them was, like I said, the private incentive, the economic incentive to voluntarily disclose. And another really powerful one is that, as you can see, all jurisdictions require companies, issuers, to list their offering on a licensed platform. You can't just sell your securities straight to your mailing list. What this means is that the platform acts, as a gatekeeper. The platform decides, like the New York Stock Exchange, which companies am I going to list and which ones am I not. And the platform makes money when investors come and invest. They get a 2% or something. And so if a platform were to allow terrible or fraudulent companies to list on their platform, investors after a while would get frustrated with that and would go to a different platform. The platform knows this, so they're very, very strict in who they allow on. And not only in the US, but around the world, the leading platforms, at least in each jurisdiction, reject upwards of 95% of companies that say, hey, can I raise money on your site? They keep it very strict. Their gatekeeping is very strict. Now, so in the end, my basic point in the book is to introduce investment crowdfunding, to describe the purposes and the legal framework and the private incentives. But as you could probably tell from my, style of talking, that I'm really quite a big fan of this method, and I think that it has tremendous potential. And really the reason, it's one of the greatest things in the world. It's called an asymmetric bet. Asymmetric. If one of these companies does well, they're going to hire employees, the economy will develop, we'll have new products and services, great. If it fails, worst case scenario, the world is down $5 million. We can never, and each person maybe could lose 1,000 or 5,000. It's not great, but this is totally different than, the people that had all their money in Enron, or the people that bought some silly coin and they sold billions of them, and there was no, it turned out to be fraudulent or worthless. Those have significant downside. Here, we've cabined the downside, we have unlimited upside, and with some thoughtful regulation, the market could really grow, I think, to be a significant source of capital for our country. So with that, let me thank you for your attention, and I'll hand it over to Professor Beck.
Well, thank you so much, Professor Schwartz. It's really interesting, and I'm a big fan of the book, by the way. I highly recommend that, reading it. I have really three broad questions, and then I'd love to open it up to the public. One is if you can just touch base a little bit more about how exactly does it work? What do I mean by that? Let's say I decide to invest. What do I get in return? Second, what does my liquidity look like? Should I expect liquidity, or am I going to be stuck with this company that I just invested in? Third, am I considered a shareholder of record? And then am I going to meet that registration requirement like startups do, right? If you have over 2,000, do you have to then file a registration statement, or it doesn't apply in this case? So this is just one. The second, if you can touch a little bit on the audited financials, right? So what you're saying that the disclosure is voluntary in some countries, looks different here. If you can just touch a little bit on that, on the disclosure regime. And the third is I would love to hear a little bit more about the private ordering, because that's the fascinating story to me. And that is, how do we do it here in the United States versus in Australia? Do we have parties that are going to come in and basically be the signaling tool, right? In finance, we have signaling tools. How does that work here? And do the platforms encourage that or not? And maybe in that regard, also touch on the platform. What do they recommend, right? In terms of the investment, how do you do that? Do you have to give the money back? What limits do you put in? Just explain a little bit to the audience, again, the mechanics. Thank you.
Thank you for those 19 questions, Professor Beck. I'll do my best. So what exactly do you get? I think it's essentially you kind of have an account on each platform, and they keep track of your investments. Kind of like Robinhood or something like that. But each platform is kind of a standalone entity in that way. And on the liquidity question, so liquidity means you can sell your share. And one of the great things about public companies, like on the New York Stock Exchange, is that they are liquid. If you don't like how Disney is being run, just click, 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 sell your shares. But private companies and startups and the sorts that we're talking here are totally different. If you invest in a startup company or in like a laundromat in the neighborhood, you can't just sell your shares. There's not a ready market out there for it. And in fact, even the U.S. law, the Jobs Act, specifically says securities that you purchase through investment crowdfunding, you may not sell for 1 year. You have to hold them. Other countries don't have this rule, but it kind of doesn't matter because the number of shares that are issued, or the number of securities that are issued by a company, is so small that there's not the volume of people that would be interested in trading to have a daily liquid market. That said, a couple of the platforms in New Zealand and here too, maybe in the UK, have set up sort of trading days or trading windows. Like 1 week during a quarter, they say anybody who wants to trade, post up, if you'd want to sell, if you'd want to buy, and they try to kind of match them up. It's a pretty simple world, but for the most part, I would say these are almost entirely illiquid investments, which is the nature of angel investing and venture capitalists. That's what they do. They invest and then 7 years later, they hope that they're going to sell the company or something. Final question of the first part. The shareholder of record. This is a good point because there is a rule in the securities laws that says once you have a certain number of shareholders, whether you want to or not, you're considered a public company and you need to register with the SEC and put out quarterly statements and things like that. That could be a concern. The SEC, after they promulgated the initial regulations in 2016, have made some amendments and reforms over the years. And one of them that they made, which was called for by people in the industry, and it almost is almost like an inflection point. Like from 2019 to 2020, they put in a new rule, and the rule is, well, let me tell you the problem. The problem was, let's say you did crowdfunding and you have 1,200 shareholders, new shareholders. Great, wonderful, you got some money, company progresses, now you want to go get some further financing from a venture capitalist, say. The venture capitalist looks at your cap table. Who are your shareholders, your capitalization table, and the venture capitalist sees 1,200 people. The venture capitalist doesn't want to be the 1201st shareholder. If there's 3, okay. But that's just, it's a non-starter. So, a few years into the market, the SEC was, after being yelled at many times for exactly this problem, adopted a new regulation that allows companies to use what's called a special purpose vehicle, an SPV. And so essentially, the company that's raising money gets one new investor, the special purpose vehicle, some entity. And then all of the crowdfunding investors get shares in that SPV. So the corporation, the company, only has one new shareholder, the SPV. And then the SPV has many shareholders, but that's how they've avoided the shareholder of record problem. Continuing, the audited financials question, one of the expensive and I'm trying not to say ridiculous. One of the expensive aspects of the original Jobs Act in 2012 was that companies that raised money in this way had to present, or at least if they raised over a certain amount of money, had to present audited financial statements that comply with GAAP, G-A-A-P, Generally Accepted Accounting Principles. For a startup that was founded 8 weeks ago, to spend the money to get a GAAP audit to say, yes, you have $10,000 in the bank, it's incredibly wasteful. So the SEC, to their credit, said, if this is your first time for rookies raising money through crowdfunding, you don't have to give those audited financials. You have to give financials, but they don't have to be audited. It just needs to be certified by the CEO. So now, if the company comes back and raises money a second time, okay, it's more mature. It has some money by definition, and then it has to. But the audited financials, that alone would have made investment crowdfunding effectively cost prohibitive. And so the SEC changed that, and New Zealand, I don't know if this is working, yes? New Zealand and the UK never did that from day one, and that's been tremendously helpful. The final question from Professor Beck, and it's an excellent one, is can I expand a little bit on the private ordering? What other mechanism? How do you expect a whole market to function with basically no regulations? Like New Zealand, you can advertise anywhere you want. There's no mandatory disclosure. People can invest as much as they want. There's 2 rules in New Zealand. You have to go on a listed platform, and you can only raise 2 million New Zealand dollars. Otherwise, it's whatever you want to do, you can do. So I mentioned gatekeeping. I mentioned the incentive for voluntary disclosure. And let me mention 2 more. If you read the book, and it's going to be in the library maybe tomorrow, there's more in there, but let me mention just 1 or 2 more. First, and I think Professor Beck was sort of alluding to this, I call it in the book, and I didn't make up the term, syndication. Syndication, where you have a lead investor, somebody who invests $400,000, like a hedge fund or a venture capital fund, that invests a huge amount and announces either formally or informally, to the crowd, hey, I just invested $400,000. I looked carefully at this company. I think it's a really good bet. Now you who are sitting there saying, hey, how should I invest my $400? You can just follow the person who is a professional investor and has $400,000 in the game. It's not really efficient for you to sit down and spend 3 weeks poring over the documents for your $400 investment. And then the only other private ordering mechanism that I wanted to mention, and I'll tell you, it's been completely neutered here in the U.S., is the wisdom of the crowd. This is crowdfunding. The whole idea is that maybe the venture capitalists in Silicon Valley don't know everything. Maybe there are some companies out there that they don't recognize the prospects, but others might. And so the goal is that everybody kind of knows a little something, and collectively we know a lot. That's the wisdom of the crowd. And it's harnessed through the all or nothing mechanism, that the company announces how much it has to wants to raise, and then the crowd kind of votes which ones are we going to fund. It's a really useful mechanism. However, and I'm sorry to end on this point, Americans are special, and it's distinctive in the world what we have done on this point. Other countries have not done what I'm about to describe. The platforms that run this business, they want all of their issuers to succeed. They want everybody to meet their goal. So they tell their companies, make your goal $10,000 and give yourself 11 months to get there. Lo and behold, every company succeeds. And this mechanism of some are going to make it and some won't has been kind of destroyed, to my chagrin. And I've made multiple recommendations to the SEC about ways that they should remove regulations and slim it down. But here's one where I think they should add one, and I'll just conclude with what my proposed regulation would be, is I would say the SEC should just put in a rule that says you can say whatever, probably there should be like a 90-day limit on these things. But then in terms of the target, you could say whatever target you want, but you can only walk away with, let's say, 4 times whatever your target was. So you make it 10,000, that's fine. But once you hit 40,000, that's all that you're allowed to collect. So I think that this would lead companies to do what they do in other countries, which is put forth realistic numbers, 300,000, even $1 million sometimes. And sometimes they make it and sometimes they don't, but that's the point. Thank you, Professor Beck.
Thank you. Thank you. So let's open it up to questions.
My friend.
So in Ohio, we recently, passed something that allows people to sports bet, and they can put 100% of their paycheck onto this sports bet. So when you were talking a lot about inclusivity, me as a student, I don't have any income. So technically I couldn't invest in any crowdsourcing. Whereas if any money I get, I could put automatically into, a fairly risky bet, with a sports bet. So have you looked into that or?
Well, let me make 2 points on that. First of all, I agree with you entirely that if the state is going to say you could literally go gamble, then you should let people invest in startup companies, even if they are non-accredited investors. But one thing I didn't mention, and look, there's a lot in the book. I didn't tell you everything. One of the rules in the U.S. is that even if you have an income of 0, you can invest, I think, $2,500 or maybe $2,000 a year. There's a minimum. So regardless of your assets or income, you would be allowed to invest a small amount. I don't know if you have it, but good luck. Yeah. Please.
Results. What like in angel fund investing, the rule is 10% will succeed. What's it like in this crowdfunding world, and do we have 3 examples of the best results?
Good. Thank you. It's a good question. So right, the question is, what are the results? We see how much has been invested, but what are the returns? Are people making money on this? To cut to the chase, I don't know. But it's not known. It's just not known because the nature of these sorts of investments are that they are illiquid, and you got to give them time, 5 years, even sometimes longer, and to see what happens. Because kind of the best outcome for these sorts of companies is usually to be acquired by another company, possibly to go public themselves, to have an IPO. And but so the whole market only started a few years ago, and in those earliest years, especially because the SPVs were not allowed, in those early years, the conventional wisdom was, if you ever want to raise money from venture capitalists, you better not go through investment crowdfunding, which meant that in the earliest years, only the most desperate companies were really seeking this out. More recently, and especially in the UK and in Australia and in New Zealand, there's really been, and to some extent here, there's developing a nice synergy between the kind of the venture capitalists and the crowd, where a venture capital company fund will invest, let's say, $7 million in a company, and then direct the company or in conjunction, run a crowdfunding campaign to raise another couple of $1 million, where the company could say to the crowd, hey, we were just invested on these exact same terms by this venture capital fund. The venture capital fund gets more money for their portfolio company. The company gets more money and the support of, sophisticated venture capitalists. And something I kind of haven't mentioned is the people that often invest in these companies are what I call brand ambassadors. People that love the product or use the app or whatever it is. They know it and they love it. And so they also invest. Breweries, for example, in New Zealand and elsewhere, breweries do very well. People invest in the brewery. Then when they go to the supermarket, which beer are they going to choose? And what are they going to tell their friends? Oh, this is delicious. So you get this multiplier effect on it. And then so just finally, I'll try to answer your question, which is what are the outcomes? In the UK especially, which has a longer track record, there are dozens of companies that were acquired for huge multiples, or even a couple that have gone public in Australia as well, went on to an IPO. But it's really just anecdotal. There are a good number of success stories, and then there's thousands of we just don't know. Please.
You have described these projects by different countries. Using the internet, isn't there a lot of crossovers? And how would a person deal with it? U.S. citizen, couldn't you purchase something that maybe on a UK platform? And would you be following U.S. rules, or would be the UK?
It's a very good question. I'm just going to repeat it for the microphone for the recording, which is because this is all done over the internet, what happens if a U.S. investor goes on a UK platform? Which law applies? Or can they do that? The answer is that the websites, through technology, know where you are, where you're dialing in from, where your computer is. And if you were to go onto a New Zealand website, a screen would pop up and say, it looks like you're in the United States. These offers are not for you. So each jurisdiction governs the offers that are made to its residents. So I could, for example, have a company here in Cleveland, and at least in New Zealand, some of them go the other way, but I could go to New Zealand and put up my Cleveland-based company and list it there, but I can only get investments from New Zealanders. Most of the jurisdictions also have a rule that only domestically based companies can raise money in this way. Like in Australia, you have to be an Australian company. New Zealand happens to be, hey man, wherever you're from. But like I said, New Zealand is only governing offers to New Zealanders, and so you would not be legally allowed to invest there. Please.
So out of these regulations, which one do you think is most likely to be loosened, I guess, in upcoming year?
Yeah. Okay. Good question. Do we expect any of these jurisdictions to be more liberalized in the future? In the U.S., every time the SEC has had an opportunity, it has liberalized and loosened the rules. From when it even put out the initial regulations, and in 2020 they made some revised regulations like the SPV, raised the investor cap actually from 1 million to 5 million in that year. So there's been moves towards liberalization in the U.S. Australia kind of had this nice benefit. Now, I don't know if, so Australia and New Zealand is a little bit like the US and Canada. And there's a big brother and there's a little brother. And down in the South Pacific, Australia is the big brother and New Zealand's the little brother. It's about 5 times as many people in Australia. New Zealand, like I said, they adopted a crowdfunding statute in 2014, and Australia was like embarrassed, but they couldn't get it together, and they didn't until 2018 when and then they passed something that was totally ineffective, and then they had to revise it the next year. But my point to you on this is that Australia has done very well once they got started because they looked around the world, especially at the UK and New Zealand, and adopted a lot of those liberal rules. And Canada also. Canada is funny. They don't have a national securities regulator. They do it provincially. But they kind of set, but for many issues, the different provinces come together and say, let's all agree on a common rule, whatever it is. And so they had tried over several years, and different groups of provinces were sort of dueling. And then they enacted something that was so regulatory heavy that it was impossible to use. But then finally, Canada, it only went into effect maybe within the last 18 months. But again, it was more liberalized than what has come before. So at the outset, back in 2012, Congress was, this was unknown. We didn't really know. And Congress was really worried that this was going to be, full of con artists and problems and bad things. So they put in a lot of rules. As we have more experience, they've relaxed them.
Ask another.
Yes?
As you know, most companies fail for 2 reasons. One, marketing, and secondly...
You got a microphone.
Sorry. Most companies fail, or many companies fail, because their marketing and their pricing is not sophisticated. Marketing-wise, so often the entrepreneurs say, hey, I built a better mousetrap, and there'll be people beating down my door, and they're surprised when nobody does. And then pricing, most people price their products on the basis of cost plus. And it's related to the marketing thing. If you understand who's going to buy your product, then you have a different way of pricing. So I don't know if any jurisdiction provides some advice on marketing and pricing.
Well, I'll mention that regarding advertising, consistent with what I've been saying, in the original Jobs Act, there were extremely strict limits on advertising. Effectively, advertising was not allowed. All you can say was, we have an offer up on this certain website. Go see that site for details. You weren't allowed to say anything. New Zealand, from day one, these other jurisdictions, the UK, they advertise to their heart's content. If you maybe you're not friends with these people, but I'm friends with them on LinkedIn, and all the time I see, come invest in this company, come invest in that company. In Australia too. The U.S., again, with in a deregulatory, liberalizing move, the SEC has softened that, and there is the advertising is now allowed, kind of, but you just need to, whatever it is that you advertise, you need to then add that to your filing so that the SEC knows kind of all of your public statements. I don't know if there's specific advice on marketing or pricing, but I think that probably I guess, let me say this. What I've heard from a lot of platforms and entrepreneurs is that going through this process, having to present yourself in whether it's through a mandatory disclosure or voluntary disclosure regime, is a really useful exercise for a fledgling business and forces them to clearly state what they're doing, why they're doing it, and their predictions and such. And so I think that probably the platforms probably are starting to share some best practices with these new startups that are coming in. But I'm not exactly sure about that. It's a good question.
Thank you, Professor. Actually, I'm doing. Thank you, Professor. Actually, I'm from Saudi Arabia, and I'm doing my study here. I'm doing my study thesis in equity crowdfunding, comparing U.S. laws to Saudi Arabia laws.
You can do my card.
And I have read your book. Yeah, I have read your book. Yeah.
Now I'm worried.
Yeah. Thank you so much. My concern, I went to Silicon Valley last year, and I sit with venture capitalists like Tim Draper, for example, and Nabil Noor. And I asked them about the companies that used crowdfunding. And most of them, the angel investor, the venture capitalist, not only here in the US, even in Saudi Arabia, they don't want to invest in this company. I don't know, is it trust issue or what?
That's a great question.
Yeah, this is my concern.
Excellent question. I'd say there's two key concerns, I think, from venture capitalists. Who would, whether they're going to invest in a company that had previously done a crowdfunding round. One issue, and I think this is quite legitimate, is a concern over secrecy, trade secrets, corporate information, even just like the profitability of the company. That's something that maybe a startup doesn't want to share with competitors. And so that's a very valid reason, and I could see that. However, depending on the type of company, especially one that is consumer-facing, like a brewery, or maybe isn't consumer-facing, but it's just the sort of thing that people are into. Like there's this, in Australia, one of their most successful companies that raise money this way, it's called sea bin, like out in the sea, like a bin is like rubbish bin, like a sort of floating thing that collects rubbish out on the ocean. And that's not really for consumers, but consumers like that sort of thing. So when for a venture capital fund, if they have a portfolio company or considering one that could that is either consumer facing or socially interesting, they could really get a synergistic double benefit from investing with the crowd. You get thousands of engaged customers that tweet to their friends, this is the best, whatever it is. That said, a lot of what the venture capitalists are investing in is sort of like a back-end stuff or things that are not really capturing the imagination, like a new way to, have the data flow more clearly through the internet. That's not something that people are going to be interested in. So, and then a lot of what they do is so capital intensive, or there's a lot of money that another 5 million isn't really going to make a difference. So there's some legitimate reasons. And then in the earliest years, there was, I'd say, maybe it was the chicken and the egg, but there was like an adverse selection concern that any company that raised money in this way must have been desperate and wasn't able to find VCs. Whether that was true or not, it was thought to be. More recently, and like I'm saying, especially in our more mature economies like the UK, the venture capitalists have really gotten on board and seen that, at least for some companies, it could really be beneficial. But let's talk more. Let's stay in touch, please. Yeah, thank you.
Oh, by the way, I have to tell everybody, I'm sorry, Andrew, that there is a reception afterwards, and I was supposed to mention that at the beginning.
Oh, so that they would say.
Upstairs in Ben's place.
Right. Reception upstairs in Ben's place in
So perhaps
3
the
minutes.
conversation will continue for some of you.
Yes. Any,
That's okay.
final question? Yes, my friend.
I'm naive.
Good to meet you.
For some reason, some entity wants to limit their offer only to residents of a given state. There may be some state tax issue or some other reason. What's the implication here versus state securities laws?
Very, very good question. Very good question. There are state securities laws that that you would have to comply with, but they're really quite straightforward in this way, and it's very easy to do an offering across all 50 states. However, your question is, what if you wanted to just do it all within one state? In fact, remember I said the statute, the Jobs Act was passed in 2012, and it took the SEC 4 years to draft the regulations. In between, 20-something or maybe even 30 states enacted intra-state crowdfunding regulations, kind of just to, I think, primarily to express their frustration with the SEC. But under a separate rule, because federal authority only covers interstate commerce. And if you are an Ohio corporation based in Ohio with Ohio, and you get only Ohio investors, that's not interstate commerce, and you could do that, and many states do have these statutes in place. However, it was all just sort of like for show, because once the SEC promulgated the regulations, almost every issuer would prefer to make their offering to all 50 states as opposed to just one. I do think that there is some Colorado platform that has just started up recently, kind of on the idea of, buy local, and let's do this locally. And so that might work in and of itself. But so thank you for that question. Thank you all very much. I look forward to the reception.